Welcome, everyone, to our deep dive into the world of capital expenditures, or CapEx. In today's dynamic financial landscape, understanding CapEx isn't just for accountants. It's crucial for anyone looking to make informed financial decisions, whether for a business or even personal long-term investments. CapEx represents the money companies spend to acquire, upgrade, and maintain physical assets like property, buildings, industrial plants, technology, or equipment. These aren't your everyday operational costs. These are investments made with a long-term vision. The strategic role of CapEx is pivotal because it directly drives growth, innovation, and ultimately a healthy return on investment. Throughout this session, we'll unravel what CapEx is, why it's important, how it's funded, and most importantly, how to measure its effectiveness to ensure you're making smart, value-generating decisions.
So let's start with a precise definition. Capital expenditure refers to funds used by a company to acquire, upgrade, and maintain physical assets such as property, plants, buildings, technology, or equipment. The key characteristic here is that these expenditures are for assets expected to last more than one accounting period, typically over a year. Unlike operating expenses, which are short-term costs like salaries or utilities, CapEx creates future economic benefit. It's about building foundational strength. These assets can be tangible, like a new manufacturing machine or a company vehicle, or even intangible, such as acquiring a patent or a new software license that provides long-term value. Understanding this distinction is vital for accurate financial reporting and strategic planning.
CapEx isn't a one-size-fits-all concept. It comes in various categories, each with its own strategic implications. Firstly, we have CapEx for growth and expansion. This involves investments aimed at increasing production capacity, entering new markets, or acquiring new technologies to expand the business. Think building a new factory or acquiring a competing firm. Secondly, there's maintenance and replacement CapEx, which is about keeping existing assets in good working order or replacing them when they wear out. This is crucial for operational continuity and efficiency. Thirdly, research and development CapEx focuses on innovation, investing in new products, services, or processes to secure future competitive advantage. Finally, regulatory compliance CapEx ensures a business meets government standards and avoids penalties, such as upgrading equipment to meet new environmental regulations. Each category requires careful consideration and alignment with overall business objectives. Beyond just acquiring assets, CapEx serves as a powerful strategic tool that shapes a company's future. It's about investing with a long-term vision, enabling businesses to anticipate market shifts and position themselves for sustained success. Strategic CapEx decisions can provide a significant competitive advantage, allowing a company to offer superior products, achieve lower costs, or respond faster to customer needs than rivals. It facilitates market expansion by enabling businesses to reach new geographies or customer segments. Moreover, CapEx is often the engine of innovation driver, providing the infrastructure and resources needed for R&D breakthroughs. By carefully allocating capital expenditures, companies can build sustainable growth, increase market share, and enhance shareholder value. It's not just spending money, it's investing in the very foundation and future trajectory of the enterprise. Making CapEx decisions is only one part of the equation. Funding these significant investments is another critical aspect. Companies typically draw from several sources. Firstly, internal funds are generated from a company's own operations, primarily through retained earnings and depreciation. This is often the preferred method as it incurs no additional cost of capital. Secondly, debt financing involves borrowing money from banks or issuing bonds. While this can provide significant capital, it comes with interest payments and repayment obligations. Thirdly, equity financing means issuing new shares to investors, diluting existing ownership, but raising capital without incurring debt. Finally, many companies use hybrid approaches, combining debt and equity, or exploring venture capital and private equity for specific projects. The choice of funding depends on a company's financial health, market conditions, and its risk appetite, always aiming to minimize the cost of capital while ensuring sufficient funds for strategic growth. Once CapEx decisions are made and investments are deployed, measuring their effectiveness is paramount. The primary metric is return on investment, or ROI, which calculates the financial gain from an investment relative to its cost. A positive ROI indicates a profitable investment. However, ROI alone might not capture the full picture. The payback period calculates how long it takes for an investment to generate enough cash flow to cover its initial cost, crucial for liquidity planning. Net present value, NPV, discounts future cash flows back to their present value, providing a clear indication of an investment's profitability in today's money. A positive NPV suggests the investment is worthwhile. Lastly, the internal rate of return, or IRR, is the discount rate that makes the NPV of all cash flows from a particular project equal to zero. It's often used to compare the profitability of different projects. These tools are essential for making data-driven decisions and ensuring CapEx truly drives value. While CapEx is crucial for growth, it's not without its challenges and risks. One common pitfall is overestimation of returns, where projected benefits of an investment fail to materialize, leading to disappointing ROI. Another significant risk is cost overruns. Projects often exceed their initial budget due to unforeseen complexities, material price increases, or scope creep. Market volatility also poses a threat. Sudden shifts in economic conditions, consumer preferences, or technological advancements can render a CapEx project less valuable or even obsolete. Furthermore, technological obsolescence is a constant concern in fast-evolving industries, where a newly acquired asset could quickly become outdated. Mitigating these risks requires thorough due diligence, robust financial modeling, contingency planning, and continuous monitoring of market trends. Proactive risk management is key to successful CapEx execution. As we conclude, let's recap the key insights. CapEx is not just an expense, it's a strategic investment, fundamental to a company's ability to grow, innovate, and compete. Making informed decisions based on rigorous analysis and a clear understanding of financial metrics like ROI, NPV, and IRR is crucial. Successful CapEx planning is about fostering long-term growth, ensuring the investments made today contribute to sustainable value creation for years to come. And finally, remember that CapEx is not a one-time event. It requires continuous evaluation and adaptation to changing market conditions and technological advancements. By strategically managing capital expenditures, individuals and businesses can build stronger foundations, seize new opportunities, and achieve greater financial success. Thank you for joining me today. I hope this session has provided you with a clearer understanding of CapEx and its pivotal role.